Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsarthi, and today we're going to discuss what the impact of RBI policy on the bond markets and what it means for investors investing in fixed income assets. Very clearly, the market was taken by surprise. RBI made two significant impact today. One was they cut the repo rate by 50 basis points, but at the same time indicated that the policy stance has shifted from accommodative to neutral, which means that which means that the RBI is saying that this is the last of the repo rate cuts for some time, and we will wait and assess any kind of data before taking any further actions. So they will not be reducing rates further from here for a while, and also may not be infusing any great amounts of liquidity. The second is that they reduce the CRR rate, which is the cash reserve ratio rate, by 100 basis points or 1%. And this is starting in September, going up to November. Basically, I think they do want to add more liquidity for the busy season, which is post the monsoons. That's when the credit starts to grow, and there will be enough banks should have enough liquidity to support the credit demands of the economy post the monsoons. So with this, they would be releasing another 2.5 lakh crores of liquidity. Now, clearly, and also in the last 5, 6 months, RBI has infused close to 9.5 lakh crores of liquidity through various means of by purchasing government bonds, by reducing the CRR, and also by carrying out buy sell swaps on the USD INR. So all this is adding so much of liquidity. So this is all what is called durable liquidity. That is this is a expansion of RBI's balance sheet, and they will be and this liquidity stays in the system. It serves to carry out two things. One is to potentially keep the market liquid in case of any kind of drop in foreign exchange reserves due to capital outflows on the back of global market volatility, which did happen sometime in the first 3 quarters of first 3 months of this calendar year, or in the last quarter of the last FY. But the RBI, but now the position is more stable, and the foreign exchange reserves have climbed back to close to $700 billion. And the RBI feels comfortable with this kind of foreign exchange reserve position, and they do not, and so hence the liquidity that they have infused will very largely remain in the banking system, and that's going to lead to one is the hope for the RBI is that the banks will not park the money in government bonds, but rather go to the lend to the economy. So these are the main impact. And what is the impact on markets? Clearly now with RBI saying that they are not going to reduce rates further, and that the policy is turned from accommodative to neutral, the impact on longer tenor G-Secs will be will be minute. As in, if you see the 10-year G-Sec yield, which once the repo rate cut was announced, it dropped by about 5 basis points from 6.20% to 6.15%. But then the moment the RBI said they're turning neutral on policy, it climbed back to 6.2%. So we don't see the the longer tenor GSEC yields reacting too sharply to this policy going forward, and they will remain flat to steady, and here and moving here and there, depending on some the demand and supply situation at that point of time. The second is that though, but having said that, the shorter tenor GSECs, which is the 5-year GSEC yield, has come down to 5.7% post the policy. And now this is what you call a classic steepening of the yield curve, because you have so much of liquidity, and call money rates, overnight rates will move closer down to the lower end of the LAF, which is at 5.25%. The repo is at 5.5%. The SDF rate is at 5.25 to 5.25%. So which means that there's so much of money in the system. You can assume that the overnight rates will be at 5.25%. And also, if you look at the T-bills, they're close at, especially the 91-day and the 364-day, they're trading close to around 5.4%, 5.5% levels, which clearly states that even the swaps, the 1 year swap yield is at around 5.4%, which clearly states that the rates are going to be low for a long period of time. So where will money then go? You can't make money in GSEC, especially at the longer end of the curve. There's been a lot of money made in the GSEC at the longer end of the curve. The yields have dropped by at least 100 basis points over the last 1.5 years. So the traders have made a lot of money, and the banks are sitting on good treasury profits. So the general tendency of the market in this kind of a scenario would be to book profits in the longer tenor yield, where they've made money in government bonds, and start to look at carry positions. Carry means where they can earn higher yields, and this would come from investing in definitely corporate bonds, which trade at a spread to the government bonds. So you have AAA corporate bonds trading in a range of anywhere between 680 for a PSU to say 720, 730, or 740 for an NBFC. But if you go down the rating curve, if you take AA and AA and below, they all start from 9% onwards, 9% going all the way to 12, 13%. So there could be a good amount of interest in investing in higher yielding corporate bonds. One is clearly the banks will drop fixed deposit rates because they have so much of liquidity that they don't want to pay higher rates on fixed deposits. So investors will definitely have to have a lot of will have to worry about dropping FD rates, and to protect themselves against sharply dropping FD rates, they will have to invest in higher yielding assets, which would mean higher yielding corporate bonds. And the banks should also start to lend more to the sector, which would mean that the economy will see more credit flowing, and there will be boost in consumption. And also the balance sheets of NBFCs will improve. The credit quality and credit underwriting will improve, given the stress that they went through and a lot of corrective actions being taken. And RBI also did say that at least on the retail loans and personal loans and credit card overdrafts, the outstandings, there's been improvement. But only they do believe that the microfinance sector is still facing some stress. But they have mentioned that there has been some corrective action, and that is going the right path. So, and with the good monsoons, the microfinance too could see some, revival in rural balance sheets of households, and that could mean an improvement in collection for MFIs. So, it is a good time for investors to start looking at high yield credits, portfolios, etc. Obviously, depending on the fundamentals of the bonds and other things. And given that government bonds will not, and this will also apply to large institutional investors who will also start looking actively at investing in the higher yielding credit markets. Just to remind investors that bonds carry credit risk, which is risk of default, the interest rate risk, which is prices can move up and down, and liquidity risk, where the impact cost of buying or selling can be very high. Thank you for listening in, and do follow us on our podcast channels.